Okay, I'm Steve Markham. Finding the optimal portfolio is a three-step process. And I'll walk you through each of those. So first, step one was to look at the past 10 years of data we had and say for each of those years, what is the best allocation among those 6 indices? And this is similar to what Carl did for that first step. And you see that the relative value fund had a 66%, that's the average of the last 10 years, had a 66% allocation to it, followed by the macro fund, or excuse me, before that, the emerging markets fund at 18%, and the macro fund at 11%, and lastly, the event-driven fund at 5%. The next step was to realize that the current economic conditions are not the same as they have been in the last 10 years. And taking an average of the last 10 years is not going to best represent current economic conditions. So we are in a post-recession economy right now, coming out of that. I see this economy similar to as it's been in the last year or two, and as well post the internet bubble in 2002, 2003. So the second step in finding the optimal portfolio was to adjust, to give more weight, more precedence to those years than to other years. In doing so, I found that the relative value fund, while it did have a major portion in that optimal portfolio in that first step, it does even better during recession, during a recovery period after a recession. And as well, the emerging markets do well along with the event-driven index, which does significantly better. The third step was to say, okay, now that we have this portfolio allocation, what kind of changes do I foresee moving forward? Which funds are going to perform the best moving forward? And I'm very bullish in 2 indices. The first is emerging markets. And when you look up here at this graph, you look at the green. That's where the money is. That's where the GDP growth is worldwide in 2009. And the first thing you notice is the countries that are green are all emerging markets, or nearly all emerging markets nations. You have China, which is a deep green. You have India. You have the Middle East, Africa, parts of South America. These are the countries that are experiencing the biggest growth. And with that, you have regulatory conditions that are improving in each of them. They're inviting investors to come in. I'm very bullish that will continue in the future. They'll outperform estimates of GDP growth and will be an excellent investment opportunity. The second fund I'm very bullish about is the event-driven fund, and for 2 reasons. The first is that it performs very well in a recession period, historically, or in a recovery period. Historically, it always has very low volatility. Just given the nature that the investments are around transactions. You're not putting your money somewhere and holding it for 2 years, but it's just around this short period around a specific transaction. The second reason is because of the global M&A activity that these 2 graphs represent. And as you can see, maybe just kind of following the trend here, global M&A in the last quarter was up 9%, quarter before that 11%. And that is forecasted to continue in the future. As M&A activity is up, as more investors put their money into the market in general, savvy hedge fund managers are going to have a significant advantage in finding arbitrage opportunities. So going back to to my portfolio, is I therefore adjusted the emerging markets index by 6%, the event-driven index by 4%, and left the relative value fund. The significant portion of the allocation is performing historically extraordinarily well in these conditions. If you were to take that portfolio allocation and maintain that for the last 10 years, today you would have just under $2,500, about a 250% return in 10 years, and that is significant because this portfolio is not designed to perform well every year. It's designed to perform well given our current economic conditions and the current growth. So I would expect to see significant returns with relatively low risk and low volatility.
Thank you, Steve. I'm Morford A, and I would also be presenting on the optimal portfolio. Now, one of the strategies that I used when I was thinking about this portfolio is I didn't so much focus on the Sharpe ratio, because the Sharpe ratio is backwards looking. It's looking at standard deviations. It's looking at things that have happened in the past. And as we know, the uncertainty that the recession created, it's almost impossible to look backwards to create the forward portfolio. So going with that, I had core strategies that I found and satellite strategies that were based off of those core strategies. Now, the macro indicators that I was thinking about was very simply jobless claims in the United States, quantitative easing, which is simply the Federal Reserve in the United States putting more money in the economy, in the American economy, thinking about the European Union backing up Ireland and Greece and making sure that that situation stays stable, thinking about Latin America and emerging Asia really keeping the world together during this recession. And so these are the things that I was thinking about as I was building the strategy, to have a sustainable strategy ready. So 47% of the portfolio, which in this case would be 47 million. So 47 million in the emerging markets. Very basically, bullish on the emerging markets. They've performed really well after a recession. They've been able to outperform developing countries as a whole. And so very bullish on them. And going along with that, 28% going towards distressed investing. And distressed investing is very simply investing in distressed assets. An example would be the National Bank of Greece. So investing in something of that nature would be, obviously you have to be very careful in what you invest in, but it will be assets that are distressed and that have a potential, an upside potential to capture. So 28% in those. Now the two satellite strategies that go with these two, asset-backed, I think that makes a lot of sense. If you're investing in distressed assets, then the asset-backed strategy also goes along with that. As assets appreciate, then the asset-backed index will also be appreciating. And on the other hand, merger arbitrage, I put that as a satellite strategy to emerging markets, mainly because according to a survey by Thomson Reuters of most all the M&A firms across the world, the most attractive region for acquisitions would be emerging Asia. And the second most attractive region for organic growth would be Latin America after emerging Asia. So most of the M&A activity that will be happening this coming year will be coming out of the emerging markets. So merger arbitrage would definitely be coming mainly from the growth in the emerging markets. Now this center one, the short bias, which is basically a short position on the market in a very small explanation, this is my hedging instrument. And so we will be expecting a negative return on that, but it's our hedging instrument. As you can tell, the correlation to both of these indices is very negative, almost -1. And the reason why we're putting 15% in there is just in the case the Korean situation and the European situation do not go as we expect, at least we have a hedging instrument so that as the market crashes, we have a hedging instrument that protects your $100 million. And so this is just explaining a little bit more. The two things that I would like to point out from this slide is mainly the fact that the asset-backed and the merger arbitrage are not only satellite strategies to those two main strategies, but are also risk-free strategies. And some numbers would be explaining that, but very basically, they have very low volatility because their merger arbitrage especially is pure arbitrage. There's very little risk involved in that strategy, and also they've never brought back, even in the time of Great Recession, they've never brought back less than -5.4%, which is, and that was in 2007 when everyone else was -30%, -40%. They were just -5%, and that was for merger arbitrage. So kind of a risk-free holding in your portfolio, and then also simply pointing out that the reason why merger arbitrage was chosen because there will be a 36% most likely increase in mergers and acquisitions across the globe. And also the assumptions that I used was very basically the assumptions of a bullish market, as I mentioned, kind of looking back towards 2003 and seeing what the returns were that year and projecting that for the future, seeing that was also after a market crash. And so this is what I was explaining about the volatility. As you can see, most of the years are below 1% as far as the standard deviation on the fund. Some years are 2%, I believe is the highest that you will see, but very low volatility compared to the 12% that you can see here, and most of them being above 1, but usually it's below 1%. And also, this is what I was talking about with the -5.4%, and that was during the recession. That's the worst that either of those two satellite strategies have brought. So really risk-free holding in that sense. And this is the short bias, which, as I said, we'll be expecting negative returns, but we will accept those negative returns because there will be our hedging instrument in the case there is a market crash, at least your $100 million will not all vanish, but you get some good returns from the short bias strategy. And so, surprisingly, as I mentioned, I wasn't focusing on the sharp pressure, I was focusing on forward-looking. And so with the next year, expecting a 24% return with a 25 sharp ratio for that year. But as I did the value added monthly for that portfolio that I created, I realized that you would get very close to a 350% return on this portfolio. So again, I wasn't really focusing on what has happened, mainly focusing on what will happen, but a 350% return, actually it's more like 344%. And so that is unheard of. And having been able to have that portfolio since the end of 1999, so beginning of 2000 till today, 350% on your 100 million, that would have been 350 million. That would have been incredible. And so definitely, I'm very bullish on the market. A hedging instrument, as with the short bias, to be able to prevent against any market crash, and definitely focusing on the emerging markets, merger arbitrage and satellite strategy, and also distressed investing and asset-backed and satellite strategy. Thank you.